Welcome, everybody, to another episode of the AgView Pitch. We're heading into a new marketing week, January 22nd through the 26th. And it's the last full week of January, unbelievably already, how fast time goes and how time flies when you're either having fun or not having fun. The markets have been a little interesting. So, what I thought today is we would bring Clark Neighbor on with us with BIS Commodities in Cedar Rapids, Iowa. So, Clark, how's it going?
I'm good, Chris. Some of these days do seem long though after moving snow every day, every
Yeah.
day, every day. But it's
Yep.
January living in Iowa, right? So
Yep. I was in Canada this last week and they got just as much snow up there as we do, so I didn't feel quite as bad. So this week now here we're going to be in Arizona with our AgView Executive Business Conference, and so I'm guessing the weather's going to be a little bit nicer in Phoenix. So looking forward to some nicer temperatures and stuff. So and we'll have some more good marketing information out. But in the meantime, we're going to pick your brain for a little bit here today on some things. And one of the things I want to start with is, and I kind of told you offline a little bit about this, but the 23 crop, there's a lot of bushels sitting in bins. There's a lot of people scratching their head. There's a lot of people with hope in their mind and in their pocketbook, so to speak, and in the bank account. And I was at a meeting last week, and I essentially there was about 75 growers in the room, and we were going over cost of production and transition and all this good stuff. And I had asked the question. I said, "How many people here are willing to unload the rest of your corn crop at 460?" And nobody raised their hand. I said, "How many here are willing to unload your crop at 470?" And nobody raised their hand. How about 480? I got some takers. I got, three or four, which kind of surprised me, but I got a couple takers there. And I think the takers were the ones that had already sold maybe a fair amount, so they weren't
sure.
unsold. They had enough sold that, their average price is still probably pretty good. Then I said 490, and I got about 30% of the room. So I thought that was interesting. I'm like, I'm getting warmer. It's getting warmer. And I said $5, and I bet you 90% of the room. I mean, there was a few that didn't, but the majority are like, yeah, $5. I'll let it go. If that's the case, if all these farmers and if that cross section, you know, of growers is willing to let everything go for $5, what lets the market go above that? Anything?
Well, in the immediate future, it seems a little difficult. I would say, Chris, based on the fundamentals we look at right now. I mean, obviously, as we get into, unless something really uh, crazy happens in South America from a supply standpoint, you probably have to get in the U.S. growing season to really put that into focus of any type of number like that. So in the meantime, the one thing I guess I would be cautious of, and what ties in with what you're saying very much, is the producer is the long in this market. He's the long in the market in a physical standpoint versus on paper, just like you're talking about. We see that uh, based on the stocks report that came out a week ago, especially in the Western Corn Belt, on farm inventory for the states of Nebraska, Minnesota, and the Dakotas is 600 million more bushels of corn on farm than a year ago. Now, keep in mind, a year ago, that area was kind of cut back with production, but the balance of the Midwest isn't a lot different than a year ago. But the
Mhm.
other thing that I think rings to this also is when you talk to a commercial or country elevator, the inventory they have in house is mainly owned by the producer also. The country elevator has bought grain, and Jim simply has moved a lot of that via rail, via truck, whatever, into the ethanol plant, into the export trade. So, because of that, if and when we do get a rally in the market, maybe more so if uh, any kind of rally is going to be suppressed by that producer selling you're mentioning, because it'll end up being hedge pressure into the market. So it's kind of a situation where if we get a little momentum going to the upside at some point, it's going to be a lot more difficult. Now, keep in mind, the commitment to traders report on Friday came out, and the funds continue to pile into the short side. They're short 260,000 contracts of corn. The record short's 322. They added 45,000 shorts to beans in the last week. and open interest has also went up a fair amount during that same amount of time, especially on corn. Now, I would say we've seen areas, not big, but areas where movement has picked up in the last 3 weeks, more so right after the first of the year, maybe cash flow needs. But your point on $5 corn, I think, is interesting and I think is understandable. Let's see if that happens. But I also think the other side of the coin might be a point in the calendar that creates movement when cash flow needs may come into play prior to planting, that type of thing. So it's going to be interesting how that all plays out, Chris.
Mm-hmm. So to tack on to that, then a bit, you talk about calendar being a consideration that probably pulls some grain into the mix, but we're going to have to be able to sort of navigate basis a little bit along the way here too, because if the price, if we do in fact see a bit of a rally or whatever, typically what happens is basis goes away and we're still at the same price. Is there anything that producers should be thinking about in terms of navigating that basis opportunity? And maybe because there's going to be a day when you probably should set basis. There's going to be a day probably when you should set price. And sometimes basis is before price and sometimes price is before basis. Anything that you guys are thinking about in terms of like kind of navigating that opportunity or challenge?
Sure. So the one thing to keep in mind, it kind of ties into what we're talking about. I think we're because of the inventory held by the producer, if and when it does move, it not only suppresses any potential the upside of the board, but I also think it limits basis potential also. So how a producer may want to look at that is when the market's kind of in the doldrums right now, and as it has been, for 30 days and more so since the crop report a week ago, it's challenging. But if there's logistical opportunities to move because of poor roads or delivery into certain markets is limited and there's pushes, I think it's important to take advantage of those. I mean, an example is we're seeing that to some degree in Cedar Rapids right now. But I think some of this recent push is because of snow, because of cold weather, et cetera. Once the weather frees up, you lose some of that strength. So the other side of the coin is there a window where demand picks up, creates some additional basis? It could, but I think that's limiting also. So I would think, and it may be rare, Chris, that this is a time frame where not only the board but basis, especially on corn, may have some limitations going forward just because of the inventory that has the opportunity to move. And once it does, it could soften both segments. Keep in mind, and again, the calendar side, you get to March 1st, you get cash rent due, you get property taxes. That seems to be the next window where a lot of cash could be needed. It's also a time where, if producers have ownership in commercial space, every month is so much a month as far as storage. You tie in the interest cost of that, the meter's ticking. It's also a time where if there's basis contracts with that country elevator, those will have to be rolled or priced come the end of February. That was kind of a really tough scenario in late November for producers that had basis contracts coming out of harvest and rolling into March because the spread widened 5 to 10 cents in those last 2 weeks because of that, partially. I think that's something to consider. If producers are sitting on basis contracts waiting to price, be really careful that last 10 days, 2 weeks of February before we get to March deliveries, because in late November, that was eye-awakening, I think, for a lot of people, because you had, let's just say, for example, basis contracts that were priced at 20 under the December. Once they got rolled, they were 40, 45 under the March currently. And now that decision is going to need to be made in late February again. So be pretty prudent on going to the tail end of February, because of the cash flow needs. Do we see movement? We'll see, but also having to make a decision on certain cash contracts at that time.
Mm-hmm. Talk a little bit about soybeans as well. There's not as, obviously, I think a lot of producers and I think a lot that listen to this podcast probably had the majority of the soybeans out of the equation priced in the fall, but there's probably still some sitting around. What do you guys see in there? What are you thinking? What are you watching for soybeans?
Yeah, I would say the bean inventory in the country is not as concerning as far as the amount as corn. I think it was marketed a lot cleaner at harvest time, and looking back, both corn and beans, the best sales were right off the combine generally this year. Um, Beans are going to depend on uh, if we see some potential on basis going forward, mainly from an export point of view, I think to capture some momentum. But I think corn and beans are kind of in the same scenario right now, unless we see some late supply issues in South America, and that still could happen. But there's a fair amount of the growing season left till harvest, and that gets strung out. But um, we did see a Chinese announcement of beans this morning for the first morning announcement in like 30 days in soybeans. It was a little bit of a mystery on the sale because we're not competitive right now with South America into China. Throw in all the logistical issues on ocean freight because of the Panama Canal and the Red Sea, et cetera, et cetera. But um, that was at least a little bit of a light for the market this morning, but the board rallied for the overnight and a little bit this morning and basically lost all that ground as the day wore on. But point being is we're kind of winding down that export window as far as soybeans, and conversely, typically we see the buildup in corn inspections going forward. So I would continue to move beans, namely on the scenario of, it's 7, 8, 9 cents a bushel a month, the whole beans right now, just from an interest standpoint. And I think the other thing a producer may want to look at, both in corn and beans, especially if they have commercial space that they're paying for on storage, if their need is to continue to have ownership, a cheaper way to own or re-own might be sell the cash, and call options are fairly cheap right now because the market's not doing much. The re-ownership of some call premium is presumably cheaper than storage and interest on your money. So something to consider that way too, as far as if a person feels they need to retain ownership.
Yeah, and I've been encouraging people too to look at as we start wrapping up 23 and we're looking at the cash flow final quote unquote with the remaining bushels to price. If the producer was in an area where the yields were down, crop insurance is a consideration because if there was, for example, they got 50 cents a bushel, if they take their total crop insurance premium, divide that premium by the or that indemnity, I shouldn't say premium, indemnity by the bushels that they produced. If it's, let's say it's 50 cents and their average selling price is, you know, currently maybe let's say it's in the mid fives or whatever, but they got to sell the rest of it at a lower price. They're probably close to $6 with that insurance premium or insurance indemnity, unloading the rest of the bushels and sticking a fork in 23.
Sure.
Probably not a bad idea. And then if, like you said, if you want to leave the top side open a little bit, the call option strategies a consideration too. Just to, I think navigating this thing here in the next, couple of months is going to be interesting because like you said, you've got the calendar, you've got the interest rate cost, you've got cash flow needs and all of these things. With that said, the last thing before I have one other last thing, but funds and the interest from the funds, let's say something happens and, you got wheat, corn, soybeans, you got kind of those three sisters bouncing around. If one of them takes off, and is it the wheat or is it something, does everything go along with it or do these things stay pretty separate because of the situations we're in or what's your thought there? And would the funds step in? I mean, because like you said, they're going the wrong way right now for us, but is there anything that could turn that around from a money flow standpoint.
Yeah, I think a couple things to consider. I mean, honestly, Chris, the most bullish thing in the market right now is everybody's bearish, including the funds.
Right.
So to reverse that, obviously that takes some sort of a change to create that change in momentum. At some point that'll happen. Is it in 2 months, 2 years? I mean, that's the issue. The other commodity to watch, and sometimes is the tail wagging the dog, so to speak, is the energy trade. Crude's in the low 70s. Considering all the geopolitical things going on in the world, I think 12 months ago, if somebody told you crude's in the low 70s, they said you would be crazy. There are some analysts out there looking for the energy trade in general to get cheaper, less expensive. Maybe that's a slowdown in world demand, whatever that could be, slowdown in economic activity here and overseas. Keep in mind, the U.S. is producing more oil right now than we ever have. So sometimes the energy trade can guide us where the rest of the commodity world is. So I think that bears watching. For some reason, if crude, because of geopolitical issues or whatever, takes off, that may help pull all commodities and maybe more specifically grains along with it because of the ties with soybean oil and corn for ethanol, that type of thing. So I think that bears watching. The other thing I was going to mention too, when you look at the funds and where the market's trading, we were looking at some charts going back basically 10 years, comparing different years, if you will. And we seem to be in a somewhat, I would call it, transition right now. If you look at the last 10 years, the bean market has spent very little time between the levels of $11 and $13. So when we rallied in late 20, since that time, we've traded mainly above $13 here till just recently. Prior to that, we spent a lot of time below 11. Conversely, on corn, very similar. We've spent 3.5 years or whatever above $5. And prior to that, a lot of time below 4.20. So we're kind of in this transition area potentially. I don't know if we know, the market knows where that gravitates towards for another 6-8 months. We may have to get another growing season behind us to know if we're below that level or above that level. Another kind of interesting tidbit, I think this is probably more just timing than anything, but one thing we were looking at the other day too, when you look at the crop yield on the report last Friday, ended up being a record yield on corn, but at the same point it's below trend line. And we've went 5 straight years where the corn market's slightly below trend line, and we've had fairly flat yields the last 10 years. But one thing that's interesting is in the years of 1994, 2004, and 2014 were big record yield years. Not to say 2024 is going to meet that pattern, but at the same point, you could argue the market may be due for a big crop. At the same point, you could argue, well, it's been a while since we've had, a tough year via drought or whatever it might be. So we'll see what 2024 brings. But I guess I would say this: if we're above trend line yield 12 months from now, I'd say there's pretty strong probability we're in that bottom range I talked about, 420 and less, more typically than we are above that, based on that information, if that makes sense. So based
And
on carryout stocks to use.
yeah, and we're going to find out what the low parameter is. I mean, we've had some inflation since, recently here in the last 4 years. And so there's probably an inflationary impact
Correct.
that will maybe like sort of subtle, make that lower number a little bit more subtle, but we'll find out what that number is in the event we get a big crop. You're going to find out
Right.
real quick what how low can we go and stay, for a bit. So last thing I want to hit on, 2024, there's not a lot sold. We're going to potentially run into the same issues, with the 23 crop when prices rally, and at what point do people sell? I think there's a lot of people in the same boat you know, in numbers above $5, I think a lot of growers would be, from what we see anyway, from cost of production, if guys could sell the whole crop at 520 right now and get cash on farm at $5, that would keep people whole for in a lot of cases. But the cost of production is interesting because it's not that much lower than it was last year. It's a bit lower, but on average, I'm kind of surprised that, it's still a fair amount higher. Land rents haven't come down. Machine
Sure.
and equipment costs are still the same. Fertilizers come down and and some of those things, but a lot of things have not come down that much yet. So it's still a fairly high cost production. If we yield more, that's the fastest way to lower our cost of production. But what's your guys' take on 24 and what people should be watching and paying attention and having some targets in there?
Sure, and it's a good point. I think your note on very little new crop sold is accurate in most cases, not all. And I think a lot of that, Chris, bases on, when there's a lot of old crop to sell, new crop's really not in anybody's mindset too much. And up to the last 3 weeks, we went kind of through this time where if you look at December 24 futures, we spent a lot of time between $5 and 520. It was just kind of clockwork, which ways are going to break out. Now since first of the year, especially, we broke out to the downside. It seemed like on January 2nd came in and the funds just added their shorts and the market's been kind of soft since. So we're not terribly far from $5 on the futures. I think if you can approach the 490 area between now and say March planning intentions, and I know a lot of people are going to focus on February for crop insurance and that type of thing, that might be an area to just stick your toe in the water and get some coverage, whether it's with the board, K-sale, short dated puts. I think there's many ways to look at that, but I think that's an area where to play defense of what may happen next fall if we have a good crop, even though that may not look good today. Some of that may look good down the road. So I think that's a good stepping stone, especially between now and the end of March.
Mm-hmm.
20 to 50 cents higher on the beans, similar scenario. Stick your toe in the water, not heavily. Usually January, February are not the best times historically to sell new crop. Obviously, it's more early growing season historically. So I don't think you want to get real aggressive, but I think those are areas where at least if a person can get, again, stick their toe in the water, 5-10%, maybe as much as 20 if they haven't done anything yet. I think those are good starting points. Now there are a few isolated people that have, 25-50% of next year's crop locked in, but I say that's very isolated situations from what I can see at my desk.
Mm-hmm. Yeah, I think the profit managers we have for 2024, we've seen with what's marketed currently is right around 14% on corn and some percentage, I can't remember off the top of my head, but I think it's like 8 or 9% or something on soybeans. So the numbers are pretty low. They've been low the last couple of years though, because
Sure.
we've been trained to do nothing. And so we're doing what we've been trained to do, and now it's not the right thing to do. So, it's just one of those things we really got to probably step back and look at what our costs are and really manage that risk. I like what you said about, figuring out some way to put a floor in, and figuring out how to at least mitigate some of the risk, because the crop insurance is going to do some for us, but we also may have to do a little more than the crop insurance depending on what that spring price comes in this year, because that may not be enough this year. I mean, last year it was like this huge blessing. We may not get a blessing this year. We might just get a number, and it's probably not going to be enough from from truly mitigating the level of risk that we need to do. It's probably going to get us close, but it's probably not going to be enough for a lot of producers. So anything else I didn't hit on as we wrap up here? Anything I didn't ask or throw out there? Or are you pretty good?
I think we're pretty good. I would just, again, keep the new crop in mind. don't lose sight of that, even though the price doesn't look real attractive right now, just to play a little defense short term, getting some in play. Again, whether it's depending on the individual, whether it's some option play, especially short dated options, because the premiums aren't as much. Again, option premiums are pretty low right now in general, just because markets don't move much. But yeah, just keep that in mind. And again, like I said, we seem to be in that middle ground of that transition potentially in the big picture on price. So keep focus on that going forward. Where do we need to gravitate towards?
I think a lot of producers have gone through the 5 stages of grief and they're in the acceptance phase now. So now it's a matter of deciding, okay, maybe I start letting some of this go when we get a little bit of a rally, a little bit at a time, a little bit of rally, a little bit
Yeah,
more, just don't beat yourself up. I mean, there's so many people in that same boat, and so I think that's something to keep in mind. And don't beat yourself up. I've seen a lot of people this winter that are pretty frustrated with themselves, and if we were all perfect, we'd all be in Vegas on vacation right now or something if we all knew
sure.
what to do. So
I think that's a good comment to make to them because as far as being discouraged or beating themselves up, not that it's good, but that club is big right now, so they're not alone, generally in that thought process. So, yeah.
yeah, so no, hey, I really appreciate it. If people want to get a hold of you, get or have some questions specific for you, what's the best way to reach you?
Yeah, they can just call our office here in Cedar Rapids. Phone number is 800-373-2525 or biscommodities.com on the web. There's 4 of us here in the office, and everybody works with producers and trying to navigate what they do individually versus, just general vanilla recommendations, if you will. So
Yep, it's
enjoy
all
having
about
the
the
visit.
specific farm, specific
Yep.
situation for sure. Well, hey, Clark, really appreciate your time today. Clark Neighbor with BIS Commodities in Cedar Rapids, Iowa. Thanks.
Thank you, Chris. Appreciate it.
You bet. Thanks everybody for listening too, and also stay tuned. This week, we're going to be at the AgView Executive Business Conference in Phoenix. There's going to be some good information coming back from some of the speakers, and so if you're not there, we'll be getting some good podcasts out with that information. So stay tuned, and we'll catch you next time on the AgView Pitch.